After my recent portfolio update, one question came up. Why did you sell half your income ETFs? Now, before anyone thinks I've suddenly gone off these ETFs, that's not the case at all. In fact, I'd happily still own most of them. The reason I made these changes wasn't because they're bad investments, it was because my investing strategy has evolved, and I wanted my income pie to better reflect the goals I'm trying to achieve. In this video, I'll explain the thinking behind every sale and every purchase, why I wanted to increase the amount of reliable monthly income my portfolio generates, and how the research I've been sharing on this channel directly influenced these decisions. So let's dive in. Before I explain each individual change, I think it's important to explain what actually changed in my thinking. Ultimately, I wanted to refine the purpose of my income pie. One of my key goals has always been to build a portfolio that generates a reliable and growing passive income stream. But over the last few months, I realized I could improve how that income is generated. Previously, only 2 of my holdings paid dividends monthly. Following these changes, that number has increased to 4, with JEQP, JEGP, LDGG and VGOV all providing monthly distributions. That creates a more consistent income stream throughout the year, which means more regular opportunities to reinvest those dividends back into the portfolio and continue compounding over the long term. At the same time, VHYL remains the growth engine of that pie. It's a fund I've got a lot of confidence in and continues to provide reliable quarterly dividends while offering excellent long-term capital growth potential. The other thing I wanted was for every holding in the portfolio to have a clearly defined role, rather than owning ETFs that overlap or blur together. I wanted each one to contribute something specific to the overall strategy. That philosophy is what ultimately led to these changes. Let's start with JEIP and IUKD. If you've watched some of my recent ETF comparison videos, you'll know I've spent a lot of time researching dividend ETFs, comparing them across factors like diversification, costs, income potential, and long-term growth prospects. Those videos weren't created simply for content. They were part of my own research process, and the conclusions I reached genuinely influenced the decisions I make within my own portfolio. Starting with JEIP, although I still think it's a solid ETF, my research left me with a greater conviction in JEGP. JEGP provides broader exposure, fits better alongside my existing holding in JEQP, and avoids becoming too concentrated in one particular area of the market, while still delivering the monthly income I'm looking for. A very similar thought process applied to IUKD. While IUKD has served me well, my long-term goal is to build a diversified global dividend portfolio, and I no longer felt a UK-focused dividend ETF was the best fit for that strategy. In my recent dividend ETF comparison, LDGG performed extremely well across many of the categories that matter most to me. And although it's still a relatively new fund, without decades of historical data, I'm confident in its long-term potential based on its underlying index and the track record of similar legal and general products. Moving on to SMIF and INFR. Again, I don't think either of these are poor investments. For SMIF, I simply found it was slightly more volatile than I wanted for the role it was playing in my portfolio, while also carrying a higher ongoing charge. And for INFR, once I introduced VGOV as my dedicated defensive holding, infrastructure no longer had a clearly defined role within the portfolio. Rather than trying to make one ETF cover multiple jobs, I'd rather each holding has a specific purpose. So why these 3 ETFs? Starting with VGOV, this has become the defensive foundation of my income pie. By investing in UK government bonds, it offers lower volatility than equities while still providing a reliable monthly income stream. It also comes with a lower ongoing charge than some of the alternatives I was considering, making it a very efficient defensive allocation. Next is JEGP. Following my research into JP Morgan's covered call ETFs, JEGP stood out as the strongest overall option for my strategy. It provides broader market exposure than JEIP, complements my existing position with JEQP nicely, and continues to generate attractive monthly income. Finally, we have LDGG. This is probably the ETF I'm most excited to watch over the coming years. Although it doesn't yet have the long-term track record that some of my other holdings enjoy, everything I've researched, from its underlying index to comparisons with similar legal and general ETFs, gives me confidence that it has the potential to deliver both attractive dividend growth and long-term capital appreciation. Only time will tell, of course, but based on the research I've carried out, I believe it's an excellent fit for what I'm trying to achieve. So hopefully that explains the reasoning behind these changes. None of these sales were made because I suddenly believed the ETFs were bad investments. In fact, I'd happily still own most of them. The changes were made because my investing philosophy has become clearer. I wanted to simplify the portfolio, increase the amount of reliable monthly income it generates, and ensure every holding has a clearly defined purpose within the overall strategy. Perhaps most importantly, these decisions were driven by research. The ETF comparison videos I've shared over the last few months weren't simply content for the channel. They form part of my own due diligence, and these portfolio changes are the direct result of the conclusions I reached. As always though, these are simply the decisions I've made for my own portfolio and shouldn't be taken as financial advice. Every investor's circumstances and objectives are different. If you enjoyed this video though, or found it useful, please consider leaving a like and subscribing to the channel. It really helps support the content and allows me to continue sharing my investing journey with you all. Thank you very much for watching, and I'll see you in the next one.